Hey everyone, welcome back to Corporate Decoder. Today, Brera Holdings PLC just filed an amended annual report for 2025, and I am seeing some major red flags in their financials and strategy pivot. Quick note, this is not financial advice, just my take on public filings for educational purposes. Brera Holdings is trying to remake itself from a sports company into a digital asset treasury, and their latest report shows just how messy that transition is. So, Brera Holdings, which trades under the ticker SLMT, is filing an amendment to their 2025 annual report. This isn't a totally new report, it is more like they're correcting or adding details to their original filing from May. They're saying it was a clerical error, but it means we need to look closely at what they've changed. The company is basically saying they missed some things in their first filing, specifically in how they talk about their business performance, their internal controls, and their full financial statements. They're also saying this clerical error did not change the accuracy or reliability of their original financial statements. That is a bold claim given they are filing an amendment. Let's dive into how the company did financially. In 2025, Brera Holdings really tried to shift gears. They went from managing sports clubs to focusing on digital assets, specifically Solana tokens or SOL. They announced this new strategy after a big private investment deal in September 2025, calling it the PIPE transaction. For context, they raised about $271 million in net proceeds from this deal. Looking at their revenue, it jumped from 1.19 million euros in 2024 to 4.48 million euros in 2025. That is a big increase of 276%. The company says this jump is mostly because they got back into owning a sports club called Juve Stabia and also started making money from staking their digital assets. Staking is like earning interest on your digital currency. They earned about 1.5 million euros from staking just from October to December 2025. Now, this is where things get really interesting and a bit alarming. Their equity-based compensation went from just 961 euros in 2024 to a massive 269,125 euros in 2025. That is an increase of over 27,000%. The company explains this huge leap is because they issued new equity warrants, which are basically options to buy stock, to strategic advisors who helped with that big PIPE transaction and other initiatives. This is a common way to pay for services, but that jump is enormous and shows how much they're giving away in potential ownership. Their general and administrative expenses also shot up from 4.47 million euros in 2024 to 37.87 million euros in 2025. That is a nearly 750% increase. They attribute this to the cost of their new strategic plans, legal and consulting fees, and also costs related to the increased sports business activities, especially with Juve Stabia. They also had to set aside about 16 million euros for bad debts and impairments, including a 14 million euro impairment on a digital asset purchase that was settled after the year ended. Then there is the impairment of non-financial assets. In 2024, they had zero impairment charges, but in 2025, it was 81.9 million euros. This is a non-cash charge, meaning they didn't actually spend this money, but it represents a loss in value of their assets, particularly in their sports business segment. This is a very significant write-down. All of these expenses led to a much larger operating loss. In 2024, their operating loss from continuing operations was 4.24 million euros, but in 2025, it ballooned to 384.5 million euros. That is a nearly 9,000% increase in their operating loss. This shows that despite the revenue jump, their costs are massively outpacing it. Let's look at their cash situation. The company was in a tough spot a year ago, worrying about whether it could stay in business. But the big PIPE transaction in September 2025, where they raised about $271 million, gave them a much needed cash injection. As of the 31st of December 2025, they had about 16.19 million euros in cash and cash equivalents, up from 1.52 million euros the year before. Management believes this improved liquidity means they can keep operating for at least the next 12 months. Looking at their cash flow statement, the story is pretty wild. For operating activities, they used 9.96 million euros in 2025 compared to around 3 million euros the year before. This is despite the new strategy and the large loss we just discussed. The big positive here is financing activities. They brought in 132.7 million euros in 2025, mostly from selling shares in that PIPE transaction. This inflow of cash is what is keeping the company afloat. However, their investing activities show where a lot of their money is going. They spent 110 million euros in 2025, primarily on acquiring digital assets like SOL. This shows their commitment to their new strategy, but it is also a huge outflow of cash. Now, this is a critical part of any filing. And Brera Holdings has some serious issues here. They've identified material weaknesses in their internal controls over financial reporting. This means their systems for tracking and reporting financial information are not strong enough. One major weakness is related to equity transactions. This covers things like issuing new stock, handling warrant exercises, and stock splits. The company admits they did not have effective controls to make sure they accurately calculated shares, kept capitalization records complete and accurate, and properly reviewed and approved equity transactions. This led to errors in issuing shares, and they even had to try and get incorrectly issued shares back from some shareholders. This is a really bad sign, as it can lead to material misstatements in financial statements. Another big weakness is in how they handle related parties transactions. These are deals with people or companies connected to the company's directors or executives. They didn't have good controls to make sure these transactions were properly identified, reviewed, approved, and disclosed. This is a major red flag for potential conflicts of interest and hidden dealings. Their management concluded that their internal controls over financial reporting were not effective as of the 31st of December 2025, specifically because of these material weaknesses in handling equity and related party transactions. This means that investors should be extra cautious because the financial numbers might not be as reliable as they should be. Let's look at the actual financial statements. Remember, these are in thousands of euros. For 2025, their net loss was 378 million euros. That is a huge increase from a loss of 5 million euros in 2024. The bulk of this loss comes from continuing operations. This table shows their revenue streams. They had 1.535 million euros from digital asset treasury in 2025 and 2.949 million euros from their legacy sports portfolio. The total revenue was 4.484 million euros in 2025 compared to 1.193 million euros in 2024. So, the revenue is growing, but the costs are exploding. Now, their balance sheet as of the 31st of December 2025, they have total assets of 164 million euros. A huge chunk of that, 94.8 million euros, is in digital assets. Specifically, Sol, this highlights their heavy bet on this new strategy. On the other side, they have total liabilities of 22.3 million euros and shareholders' equity of about 141.9 million euros. This table shows how their equity changed. The most striking thing is the massive increase in other reserves from 14.2 million euros in 2024 to 524.6 million euros in 2025. This is largely due to the PIPE transaction and the issuance of all those warrants and shares. Their consolidated statement of cash flows shows a net increase in cash of 12.4 million euros in 2025. This is thanks to the financing activities, primarily the PIPE deal, which brought in over 132 million euros. But remember, they used over 110 million euros in investing activities, mostly to buy digital assets. So, while they have more cash, it is tied up in Sol. Digging into the digital assets note, we see they hold 940,486 units of Sol as of December 2025. The cost basis, what they paid for it, is about 160.8 million euros, but its carrying value, accounting for impairments, is 94.8 million euros. This means a significant drop in value since they acquired it, before even accounting for any price changes after year. They also have a prepayment for digital assets of 28.6 million euros that hadn't been delivered yet. They even had to take a 14.4 million euro impairment on this prepayment. It seems they made a deal with the Solana Foundation to buy Sol at a discount, but it highlights the complexity and risk in these digital asset dealings. This section details their share capital and all the stock transactions. The September 2025 PIPE transaction really stands out. They issued over 6.15 million Class B ordinary shares and a huge number of warrants, both common warrants and pre-funded warrants. The total proceeds were around 253 million euros. They received a mix of cash and digital assets like Sol, USD Coin, and Tether. The allocation of those proceeds is very complex, with large amounts going to warrants. They recorded about 143 million euros as a net increase to shareholders' equity from this deal. This is where most of that massive jump in other reserves we saw on the equity statement comes from. And your analysts noted. Your analysts are noting, your analysts are noting, your analysts are noting, your analysts are noting. Your analysts are noting, your analysts are noting, your analysts are noting, your analysts are noting. Your analysts are noting, your analysts are noting, your analysts are noting. Your analysts are noting, your analysts are noting, your analysts. Lists are noting, your analysts are noting, your analysts are noting. Your analysts are noting, your analysis are noting. Your analysis of these warrants is key. Your analysts are noting that 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 your analysis of these warrants is key. Your analysts are noting that 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 your analysis of these warrants is key. These private placements and PIPE transactions have resulted in a massive increase in potential future share dilution through warrants. For example, the September 2025 PIPE common warrants alone total over 66 million, and the pre-funded warrants add another 5 million, even though they are classified as equity. The sheer number raises questions about future dilution for existing shareholders. Your analysts are noting that 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 your analysis of these warrants is key. Things get even more interesting with recent leadership changes and potential legal issues. On the 24th of April 2026, they terminated their chief executive officer. This former executive is now claiming compensation, equity awards, and severance. The company says it is too early to estimate any potential costs, but this is definitely something to watch. Looking at events after the 31st of December 2025, it is clear the company is still in major flux. They sold off their stake in the Juve Stabia football club for just €1 in April 2026. This signals a clear exit from their legacy sports business. They also implemented a 1 for -10 reverse stock split in May 2026 to try and get their share price back above $1 and avoid being delisted from Nasdaq. Based on historical patterns, about half of microcap companies that do reverse splits end up delisted anyway. It is a sign of distress. They also announced a shift in their primary operations to Abu Dhabi. So what is my take on all this? Brera Holdings is in a high stakes gamble. They've pivoted from sports to digital assets powered by a massive private investment. However, their core business operations are bleeding cash, their internal controls are weak, and they've issued a huge amount of equity and warrants, leading to significant dilution and potential future dilution. The massive increase in equity-based compensation and the huge operating losses are serious concerns. Selling off their sports assets signals a desperate attempt to focus on their sole strategy, but the valuation of those digital assets has already seen a significant impairment. The recent management changes and the delisting notice from Nasdaq add to the uncertainty. It feels like a company trying to reinvent itself on the fly, and the financial house still looks shaky. What I am really watching for is whether their digital asset strategy can actually generate sustainable profits, and if they can regain Nasdaq compliance in the long term, especially given the history of reverse splits. Alright, that is my take. Stay decoded. Your analysis of these critical filings is made possible by the tools and scanners I use daily, which are linked in the description below. These help keep this channel running, like this analysis. Hit that like button, subscribe for more, and join our Discord in the description.